Hello YouTube, it's Alexander here, and today I want to show you how you can make money even if the stock market is going down or is flat. I'm going to do this by using a method called a dollar cost averaging. And basically what that is you invest the same amount of money every single period, and in this instance, that's going to be every single month. So what you're looking at in front of you is a picture of the S&P 500, which is basically a good way of visualizing the United States stock market because it has the 500 largest companies in the United States within it. Now, the reason why I chose these states, which is about 2000 to 2013, is because during this time span, the United States stock market was roughly flat. Now, it definitely did crash twice, down here in 2003, which was kind of, the dot-com bubble, and then, of course, the financial crisis, with the banking problems in 2009, which was more recent. But basically, as you can see, is yes, we did have some big upswings and downswings, but during this 13-year period, it actually remained about flat. So if you had put a dollar in at about 2000, it looks like you would have had a dollar at about 2013. But basically, the point of this video is to show you that if you had invested the correct way, and this is a very easy way to invest, you could have actually had about a 50% profit by 2013 just by doing this method. Okay, here is an example of dollar cost averaging, just so you can kind of visualize how this works. Basically, like I said, this principle is based off the fact that you invest the same amount of money every single period, which in this case, I'm keeping it very simple, is every single year. So you invest $100 at the beginning of the year, $100 next year, and $100 the year afterwards, which would give you, as you can see, if you did not invest, $300. Now, if you did invest, and this is where the benefits of dollar cost averaging come in, but if you did invest, you invested $100 in the first year when, let's say, the stock price was $10, okay? So you put it in that stock, and now let's say the stock falls to $5, okay? So your original $100 would go down 50%, so you'd only have $50, but then you would invest another $100, so you'd have $150. But if you see above, if you hadn't invested, you would have $200. So it looks like you are losing money here. However, if the stock returns to its previous place, so 5 back to 10, which is basically a 0% gain, but it did fall here in the middle. If that happens, it's a 100% increase. So 150 times a 100% increase goes up to $300 plus that extra $100 you invested, you now have $400. But look, if you hadn't invested, you would have had $300. So just by constantly investing, you would have had a 33% profit or a $100 gain, even though the market, or in this case the stock, was completely flat. Okay, here I have the returns of the actual S&P 500 because yes, it is good if dollar cost averaging works an example, but does it actually work in real life, in real scenarios? So what I'm going to show you here is that yes, it actually does work. And as I said, I chose a 13-year span where basically the S&P 500 was flat from start to end, even though it definitely did have some major volatility in between, but that is very common and it has kind of historically had high volatility. So basically what I did is I have here on the left, I have the S&P 500 price, but I did include another column, column G, which has the S&P 500 price with dividends added. Now this is very important because dividends are extra cash that companies give out to shareholders. And this does happen whether the market is up or down. And it is important because even if the market is crashing, you are actually still getting money from these companies. So it is definitely important to add, and over time it does add up. As you can see at the beginning, it's not that substantial. The price would only be a little bit higher if you included this dividend. But if we go all the way to 2013, you can see it actually would be about a 20-30% difference if you included this dividend yield. So I definitely did want to include it because that is a realistic scenario of what your money would look like. Now here, if we go back to the year 2000, I'm showing you what it would look like if you invested $600 a month. Okay, so this is based off the assumption I'm saying you make $48,000 and you want to invest every month. So you divide that by 12 and you have 4,000. And I'm saying you invest 15% of your income. So 4,000, 15% of that is $600. So the one here in L shows what it would look like if you just kept that $600, put it in the bank, didn't do anything with it. Now column H shows what it would look like if you put that $600 and all the cash before into the S&P 500. So as you can see, remember I started from the year 2000, which was the beginning of the dot-com bubble. So as you can see, there is a decline originally. Over here it shows the profit from investing. So originally you are losing money. Okay, this is middle of the dot-com bubble. You're losing money, you're losing money, you're losing money. It gets pretty bad here. If you had just invested for 2 years, you would be down 24%. Obviously that's not good. But if you keep going, you actually start to make a profit in 2003. So a profit here just means that you would have made more money by investing as opposed to not investing. And something to note here is you're starting to make a profit here, but the S&P 500 is only 1100, whereas when you started, it was 1485. So even though it's a lower number, you're actually already profiting. Now, if we continue going up, you're profiting, you're profiting, you're profiting. You start to make actually a lot of money here in 2007. You're up 40%. You're doing really good. But then, of course, you hit the financial crisis, and it looks like you're getting a pretty big crash here. Yes, that is what happened. But if you keep going, look at this. You actually hit a profit in September of 2009. Now, this is barely after we started to see recovery. So even though we were in the middle of a financial crisis, barely getting out of this recovery, you're actually already getting a profit in 2009. And I just want to magnify this because people say I put all my money into the market, and then in the financial crisis I lost my retirement savings. Well, if you had invested this way, that wouldn't have happened, and if you had just held it for a few years, you would actually be booking a pretty big profit. And as you can see, if we go all the way up to 2013, which is up here, you would actually have a 50% profit, even though the market was relatively flat. So during that time span, 13 years, if you had done nothing with your money, put $600 in, you have $91,000. But if you dollar cost averaged it, you have $138,000 or a 51% profit. Okay, and this is very important because this is basically a safe way to ensure that you're more likely to profit even if the market is going up or down. And remember, I chose a pretty bad time span here. I chose 13 years. In general, the market is much better than that. Here again is the S&P 500, and like I said, I want to show you how, in general, the market is a lot better than this, but I did choose a bad 13 years. But again, if you had started investing in around 2000, which was the absolute peak, the absolute worst time to start investing, if you had started then, you would actually already, be booking a profit just by September of 2009, which, like I said, was just barely getting out of the Great Recession. So look at this. I mean, it looks like we're very far down in the market, but actually, if you had used this method, dollar cost averaging, you would start to be booking a profit going forward. And like I said, by the end up here, even though it looks like you are flat, you are actually up 50%. And I just want to expand out a little bit just to show you that this is not really realistic. This is a bad 13 years. If we just continue to present day, looking at us in 2019, look how much the market is up. It's up another 50 or about almost 100%. So you would be up a lot more than that. And if we go back, before this year 2000, as you can see, the opposite direction, the market actually went up even more before. If we look back in 1987, it was 250 and went all the way up to 1500. That's a 6x return. So actually, what I was showing you was a pretty dire situation, whereas normally the returns tend to be much better. But I do think this is a good method. I hope you use it, and good luck investing.